All right, hey everybody, we are live. Thank you so much for tuning in. For the folks who are in person, I do have papers and pencils if anybody wants them to be able to go through some of the income planning that we're going to be talking about tonight. For those at home, if you are wanting to follow along, again, having something to write with would be the way to go. We're going to talk about income planning, which is it's everything in retirement that's going to produce income for you. So obviously what everybody's going to have, or at least until we run out of money, that's a joke, is we're going to have Social Security. So you can kind of count on Social Security coming in. If you're blessed enough to have a traditional pension, that is another source of income that you can count on in retirement. So you kind of think of, if you want at the top of your paper, if you need $10,000 a month, put 10,000. Subtract out the pensions you're getting, and then that's the rest of that is the delta that we need to make up with some income planning. So this is kind of a brief overview of income planning, but I want to hit the highlights of things that can generate income in retirement, and you can help kind of do your own math as far as what pertains to you, if you will. Okay, you see up on the slide, we have pension income. Like I said, Social Security counts under that. Anybody know the highest amount of Social Security income you can make monthly? Nobody in the room's on Social Security right now. If you wait till 70, it's $5,000 a month. So if you're married, at that time you can think there's $10,000 a month coming in. Yes, it is taxable. Yes, it is indexed to inflation. If you wait till full retirement age, for most everybody in the room, except for the youngest, is going to be 67. So if you wait till 67, it's going to be about $4,000 a month. And again, if you both work most of your career, you're going to both get that $4,000 a month. If somebody was maybe in a traditional stay-at-home role, you're going to get, the main person's going to get $4,000, the other person's going to get about half of that. So that's kind of your basic planning. Fixed income stuff, we're going to talk about bonds, that sort of thing. We have equity income, which is now getting into the portfolio design. And then we'll get into whether if you want to stay total return investing your whole life. That's my personal preference. Stay long and strong. That means you're going to have to sell stuff in retirement to live off of. So if you think conceptually, if it generates income, that's like if you think of the cow and the milk scenario. If you don't ever want to touch the cow, then you have to live off the milk. I'm more of a let's grow as many cows as possible than kill them off when you need to live off of it. But a lot of people are more comfortable with just never selling anything and living off the income that it produces. And then lastly, we'll touch about some private investments and how those can generate income. Think rental properties, think oil rights, mineral rights, some of those things that we see here in Texas a lot. Okay, standard disclaimer applies. You can pause and read that at your leisure. Okay, when you think of your retirement planning, again, you've got your number at the top. That's your lifestyle number, which you may or may not know. But if your burn rate right now is $15,000, $20,000 a month, you're probably going to be pretty used to that when you hit 65 or so when you retire, or if you retire early at 55, you're going to need to replace that income because that's what you've gotten used to as far as the hotels you stay at and the food that you eat, those sorts of things. People can downsize, but it's usually out of necessity, not necessarily out of choice. So put your monthly expectation of I could live off of this, and this is all pre-tax, up at the top, and then subtract out that pension. So again, if you have a traditional pension, good for you. They're not that common anymore. If you don't, subtract out the Social Security there. And then the rest is going to come really out of your income. If you have a side business, that's a whole different thing. A lot of times people sell their business going into retirement, and then now that becomes part of the portfolio. But either way, you think of the rest of the pie there as your portfolio. So if you think conceptually, for every $1 million you have, it's good to have $1 million. If you have more than that, for every $1 million you have, if you can generate about 5% in income, so that's about $50,000 a year. So if you're sitting on $2 million in your portfolio, that's about $100,000 coming in. Divide that by 12, and that's your monthly amount. If, however, you don't want to live off the 5%, you can go off 4%. That's kind of the traditional rule. I think that's a little overly conservative. We'll talk about that in here in a second. Or if you really want to amp up your income to where you can design your portfolio to generate 6%. So if you got $2 million, then you'd have that $120,000 coming in, so another $10,000 a month. Those are things you can kind of think of as far as the math. But if you kind of have that number in your mind right now, that's your Social Security plus what you think your portfolio can generate based off of that math I just gave you, and then we can go from there. The pension income, that is, check of the month club. Social Security, will it last forever? Well, I think so. Obviously, some of the numbers have to change. They'll either wicker the ages or the amount you put into it. There's different levers you can pull. When I talk to folks that Allison happens to be here, when I talk to people their age, they're like, well, it'll never be there for me. It's like, well, it'll be there, but it'll probably be largely reduced compared to what we're bringing in. But we'll see. It's unknown, but I doubt it goes to zero or goes away. That would be, I just don't see that happening. It is an asset, but you can't sell it, which is good because people would if they were allowed to sell their Social Security to somebody else for, $60K. Be like, sure. So it's set up as an annuity. It just comes in. You can't even screw it up, right? It's right here, and it's indexed to inflation-ish. It's indexed to the CPIW. That's not the best weight. That's not the best assessment of inflation, but it is indexed. It does go up over time. Okay, your next one is your fixed income. This is your portfolio stuff. You can think CDs. You might have those in the bank, treasury bills, or you can think corporate bonds or junk bonds, that kind of thing. So if you have those that you're sitting on, obviously, if you sell your home in retirement and downsize and you take the equity from that, you can put that in CDs. Right now, those are generating around 4.5% to 4.6%. So you can kind of calculate how much money that's going to give you without adversely tying that, without buying something with it like a bond or fixed income. Just have it sitting there in CDs. But with interest rates now that, Trump fired somebody today, he fired the jobs number guy today. He's talked about firing Powell. I don't think he's going to do that. But I do think with the dissent we saw this week in the Fed meeting, two of the governors dissented against the chairman, which is the first time that's happened in over 30 years. Rates are coming down. We don't know how far they're coming down, but it's coming down. It's coming down by the end of this year. So the CDs that you have aren't going to be as lucrative. So right now you can sit there and get 4.5%. Probably not going to get more than 4% going into 2026. So it kind of makes it more difficult to generate that income. For income generation, I say hypothetical yield curve because the yield curve for the U.S. hasn't been like this for 2 decades. But in theory, at the bottom you would have your government treasuries and the lightest of the grays there. And then the middle number would be move up, get a little more return going out of investment grade bonds. And then the highest one is the high yield bond, or it's called junk bonds. Junk's a little rough. It really is just high yield, but generally it's up there for a reason because the risk is higher. So if you want to go more towards the equity income thing, this is a fancy name for dividend growth investing. So if you think back when, for my family, it was AT&T stock. So I had a grandfather work at AT&T. You get all these dividends, and it's like, you work long enough and you pile up enough shares of stock, there's a lot of income coming in through these dividends. So, it used to be mailbox money. If you're old enough to remember, grandma and grandpa going out to the mailbox, opening that, get the actual dividend check, and they actually had to hop in the truck, drive it to the bank to deposit it. Now everything's automated where most people don't even notice when all that stuff shows up. But it trickles in. That can be income that is set up for you. If you're with us in Schwab, you can actually set your dividends and income where anytime something generates dividends or income, it's automatically zipped to your bank account where it's collected, and at the end of the month, there's a one-time payment. So it can be a nice kind of found money at the end or beginning of the month, however you have it set up. When you go look at, though, for dividend growth investing, you need to be pretty intentional at what you're looking at. Here's your kind of your quality curves. You have quality companies. If they pay a dividend at all, they pay a really low dividend. So Apple is on the top of the stack there, followed by Microsoft. They pay a little bit, right? If you look at the other end, look at Pfizer and Altria. Those are not exactly the most favored stocks anymore. Uncle Mo was MO is the ticker for Altria, being a smoking stock, right? So a lot of people still smoke, but it's kind of gone out of favor. But they pay this huge dividend out there. So you can think of, well, if you get too far out there, you can be in what's called a yield trap. That means that they can't afford to continue to pay their dividends. So kind of the sweet spot is in that 2 to 4, 4.5%. So you think, okay, I like this. This resonates with me. I recognize companies in here like the J&J, McDonald's, Raytheon. It's like, okay, they pay enough for the dividend. I'm comfortable holding these names because they're great American names. I think they'll be around for decades. So therefore, I'm going to hold these and live off the dividends from these stocks. You can certainly design your portfolio that way. You aren't going to get north of 5% really that way. So if you have $3 million, then okay, if you only need $100,000, you can set up in this zone. If you have $1 million though, it's only going to generate, say at 4%, going to generate that $40,000 a year. That may not be enough milk from the cow for you to be able to live off of. So that's something you want to take a look at. Okay, dividend stocks. A lot of times people are like, well, I love dividend payers because they, it's money being returned to shareholders, so that's great. They all used to. Now the tech firms, a lot of them don't have those dividends coming in. But other people are like, you know what? I understand real estate a lot better. Market's scary. Don't want to deal with the market. I'll do real estate investment trusts. It's very similar to owning property and having a rental income coming in, except for professionals are doing it. You don't have to worry about the hot water heater going out or changing the floors or floods or any of that stuff. So you pay somebody else for that. However, if you have a real estate investment trust, the taxability of it, you're basically paying, you're not getting any break on the taxes of all this money that comes in. And whether it's dividends or interest, the money comes in is taxable. And REITs are just like real estate is, since it's a pool of real estate, it is sensitive to interest rates. So interest rates have not been great. Real estate has not been done great for some time now, since they have moved up in 2022. Okay, if you like the total return strategy, which I that's who I am as a person. The same stocks that I liked years ago, I will hold for a long, long time, and I have no problem selling a few shares to generate income if I need it. So that's now when you think of the milk and cow strategy, now it's like you're not just living off the milk, but you're having to make some decisions with the cow or cows, if you will, along the way. A lot of people don't like that because I accrue assets over my lifetime, I don't ever sell. If you don't like to sell, this is not your strategy, but if you have no problem selling some stuff to free up some cash, this is what you want to do. The lights just went out. So as far as the overall strategy, when you think of here, the 4% return strategy, I'll be right back as we talk about this. The 4% return strategy now comes up to the selling 4% of your portfolio, if you will. So instead of just living off the dividend income, you're looking at your say 1,000 shares of Apple and deciding it's like, okay, well now I need to sell 40 shares of Apple to get by. Obviously, if you start selling shares and you do that over the course of a couple of decades, you might run out of shares. So you're worried about running out of money. So why would somebody choose this strategy if you risk that? The growth level of the total return strategy can continue to grow over time, where when you lock into some of these other strategies like dividend growth or investment or just CDs, is they don't grow enough to be able to keep pace with your spending needs, right? So that's why I think this is superior. If you do a strategy like this, you're going to stay at least 50% equities into and through retirement. So if you've grown up on investing in stocks, then this is probably how you're going to go because you're used to that and you don't like CDs and things like that because they don't return enough. But you do have to do some math or keep an eye on it. When you think of the S&P 500 and the total returns, the line in red is the growth of the portfolio. And then the difference between the red and the blue line there is the dividends. So these assumes that dividends are reinvested. Obviously, if you're living off the dividends, then you're not going to get that return. But really, the eye-opener for this chart is if you're a lifelong investor and you've always heard things like invest in the stock market, it returns 10 to 12%. True statement, as long as you reinvest the dividend. And a lot of the return from the stock market are those dividends coming in. So a lot of people think it's just the growth. No, it's the dividends too that's rolling in. Okay, so they're 4% withdrawal rate. That's on the left-hand side of the chart. When you think, okay, I need to make sure I don't run out of money. So if you have lots of money, then you can kind of think, well, I don't have to be as worried. But if you don't, you need to kind of really look at this. At the 4% withdrawal rate, the second one down there, if you keep at least 25% in stocks, you're looking at right around that 87%. That's kind of the sweet spot. If you think, the old adage was your age in bonds. So if you're 70, you'd have 70% bonds and 30% stocks. That's a pretty good strategy to kind of get you by. However, you can see here if you go 100% bonds, even at 3%, you're risking there's a 1 in 5 chance that you're going to run out of money. So that's why you don't want to go too low and go into 100% bonds. But if you can get yourself, if you have the stomach for the ups and downs of the market, you can get over here at the 5% level by carrying at least 75% or more in stocks. Now, a lot of financial advisors will tell you that's too risky. It depends on your personality. If the market drops down 10%, you sell everything, then yes, don't do that strategy because that would be really bad. But if you're a lifelong investor, you've seen, the 1987 come and go, 1999 to 2000 come and go. You lived through the global financial crisis, 2007, 2009. You're still here. These things do happen. If you can kind of make sure you have the stomach to ride through these things, then you definitely want to be a little further out on this chart. And again, if you want to start living up to, living the good life and really spending down your money, you definitely need to stay up in the 100% stock level if your personality supports that. So that's where the math lies on that. Again, it assumes a 30-year horizon. However, what you want to be really good at is timing your retirement. So I jokingly say that because it makes a big difference when you step out the door, whether the market crash comes 10 years from now or the market crash comes tomorrow. So you just told your boss off, you left out, you spiked the football, and you burned all your bridges, leaving your job because you waited for so long to do that. You don't pay attention. They don't pay you attention anymore, so you don't even have to be nice when you leave. But when you walk out, if you look at the person in blue, that's the person you want to be. Is make sure there's a good 5-year runway of good returns in front of you. So when you step out, your portfolio can go from 100,000. And then you have those, nice returns there, so your portfolio grows up to 150,000 plus the whole time you're taking that 5,000 out. However, if you're the green guy, well, sucks to be you because you stepped out the door and immediately started withdrawing your 5,000 a year, which 5%, that's what you can do. But the returns were negative for the first 5 years. So your 100K nest egg that you thought was going to last indefinitely at 5,000 a year now is down to 50,000. And then you have all those good market returns after that, and you don't ever really catch up. So the averages, the point of this is the averages at the bottom are the same at 4%, but the results are very different depending on which path you took. So is this knowable? No, it's not. So you have no idea what's going to happen in the market. You could use political bias here to think that if it's aligned with your personal bias that life is going to be good under your particular party, then you can time your retirement there. Good luck with that. But it's something to keep in mind. So in reality, how do things change? Is if you retire and the market starts crashing, I would just go ahead and start dialing down the spending just a little bit while you think of exactly how this is going to play out. So kind of tighten the purse strings, if you will, there for a little while. And also, if things would go great, you can also spend a little bit more in retirement if the market's raging higher. But those are something you definitely want to keep track of. Okay, the last thing here is personal investments. If you have rental properties out there and they're kicking off income, you can definitely keep those properties forever and live off that income that's coming in. If you sell that property, just realize there's probably a big tax bill out there waiting for you. You can do some tax moves, which we won't go into here. If you keep the rental, you can live off the $1,500 a month that's coming in. If you sell the rental and it's worth say $500,000, then now that goes into the portfolio and you can put that into the math, whether it's stocks or bonds, and generate income that way. So just realize selling rental properties going into retirement can help free up a lot of cash flow for you. And plus, a lot of people don't want to be landlords past 60 or 70 or whatever your personal thing is. The second one there is if you're looking at like oil rights, generally those are like keep forever and pass to your heirs sort of thing because they're such lucrative deals until the oil goes dry and it's worth nothing. So that's an option for you. You can also make loans to people. I don't do this personally, and I would stay away from it, but you certainly can loan money out, and then you have to collect that loan. And then the last one on the right is property. If you have property out there, that's another good asset to possibly peel off in retirement to be able to live off the equity that you have in those assets. Also, remember, if you sell property or you sell your rental places in Texas, you just got away from that tax bill also, as well. You don't have to pay that anymore. Okay, when you think private equity, so in retirement, you go into like a Blackstone. We use BTRED and BREIT, which is the private credit Blackstone holding, and the real estate investment holding for Blackstone. These things can return north of 8% annually, kind of like clockwork. They're pretty boring, but they're the best, largest private equity company in the world, and they're very good at what they do. So you can also get a lot of income by just holding these. If you go into these, though, expect to hold them for decades. They are illiquid. You can see near the bottom, meaning when you want your money back out, it's not going to be tomorrow. It's probably going to be 4 to 5 to 6 months from now by the time you get your money out. So you don't want to put all of your portfolio in this to where you can't get to it should something come up. And then the last thing, couldn't go through with a slide without Bitcoin on it. So you take assets that you have, which not everybody has these, some or any of them, but also generate income off of those. I'm not going to go into crypto staking, but that is an option for you to be able to stake to generate some cash. What I will talk about is the preferred stocks on the left-hand side. We've started to get into these pretty seriously in 2025 because there are some offerings, mostly from MicroStrategy out there, that are kind of Bitcoin based. but there are preferred stocks that allow you to generate that 8, 9, 10% sort of yield perpetually. So when you're thinking in retirement, if I can get the 8, 9, 10%, that's like, let's take that versus the 4% or whatever CDs are gonna pay that time. Intellectual property, if you get royalties on something, good for you. Hopefully that lasts forever. In a portfolio, there are advanced option strategies, which can be very lucrative to generate some income. They can also be a little bit of a heartbreaker when they don't go your way. But either way, you can generate income with covered call strategies. And then the last one, if you do have some fancy collectibles, get this. I mean, you can rent this stuff out. So if you have a $75,000 necklace, good for you. You can monetize that, right? So there are several companies out there, whether no matter what your artwork or collectible is, you can actually loan it out on a temporary or full-time basis, not forever basis, right? So you can get it back, but you can generate some money that way in retirement. That's another higher network trick that's out there. All right, that's all I've got for the presentation. There's your folks if you want to work with anybody here. Other than that, I will take questions from the crowd. And again, I'll repeat your questions since I have AirPods in, so folks on the live stream can hear. All right, I'm going to make up a question if you can think of one. Over to me. All right, let's see. Thought I could make up a question on the fly. Is Social Security taxable? Yes. So when you go down and when you do your income and retirement math, there's going to be different taxability levels of them. There's the rules for Social Security are pretty specific. Not all of it's taxed. I think it's 92% of it's taxable though. If you're getting a pension, that's taxed for now. There has been some talk of not taxing Social Security. We'll see. I think that would be, personal opinion, dumb for the government, but it's also dumb for folks to think that they're getting free money back from the government and then get taxed on it. So, and then the dividends and income, that'll be qualified dividends. Talk to your CPA, such as Michael, if you want to minimize your tax bill in retirement. So, yes.
So you mentioned there was 4 to 5% return that we should be using as just a baseline number at returning at what age? And then is there a number for like each 5 years of retirement age? So is that 4 to 5% assuming you're working till 65?
Okay, so thank you, good question. So the question is the 4 to 5% withdrawal rate rule. When is that for, and does that change over time based on age? So it is really perpetually. So if you retire, say you're 50 and retire and you've got $2 million, you can take that, so that's your cow, if you will. So the cow's $2 million, and you can take that 5%, which off of $2 million would be $100,000, take that forever. And then the cow could continue to grow over time if you have it, and then that would, at 5%, that would increase the amount. What we didn't talk about is milk. What happens to the cow at the end of life? If you only live off the milk, then you're going to make your kids rich, because your $2 million when you're 50, if invested, like I say, to invest the total return, could be, doubles every 7 to 10 years. So that's 4 million, 8 million, 16. I mean, you could be living a ton of money to your kids while you're just living off the milk. So consider that at some point you'd want to increase that if you have wealth over probably 1.5 to 2 million, of increasing that percentage so you're actually drawing down your overall wealth and not just giving it to those darn kids, right? So yes.
So do you have a recommended age to take Social Security, and is it going to vary based off if you're still income generating? Like if I retired tomorrow from my employer, but I still have 3 other businesses, I don't want to make too much money and take it at 62, but I don't want to wait till 67.
Okay.
Where I can make all the money I want.
Good question. 1,000 different scenarios. Agreed. And I will give you the generalities of how I approach it. So the question is Social Security claiming strategy. The baseline question, do I claim early or late, all the way from 62 all the way to 70? And does it depend if I'm still working or not? Or if not working, how much income that we've talked about today you already have coming in? So that's kind of the baseline question. I'll handle it 2 ways. The first one is the program is government agnostic, which, okay, what does that mean? The government doesn't care. So the break-even's like 82 or 83. So if you claimed at 62 and died before 82, you won, because you claimed early. You got more than you would have if you waited till 70 and then died before 82. Okay. So you won by dying early. Okay. And so interestingly. If you live past 82,
Right.
and you should claim later, right? So again, like knowing when to retire is know what your claiming strategy is.
Come on early.
You will have made a whole lot more money. So you don't know that, that's an unknowable, so you back it up to what you do know. I do say look at family history. You know, if nobody's touched 80 in your family, then you might want to claim early, right? If everybody lives to 100, then I would probably wait and claim. But where normally you try to maximize investments, maximizing Social Security is, we have a program that'll run you through all the scenarios. It kind of is what it is. But I will say, for most people that don't have their retirement income, you want to take it at your retirement so you have income.
Right.
But if you're sitting on where you're like, okay, I don't need to live off this money, then it's a different issue. So for taxability, you definitely want to wait. And we would pull this out and take a look at exactly what kind of numbers we're talking. But if you're making, six figure, 100 to 200,000 in retirement, I would not claim early. I wouldn't even claim at age 67. I would wait till 70. Health agnostic, right? Wait as long as possible because you don't need the money and you're just going to turn around and get taxed on it. But I will say that most people that we deal with, the clients, they think in retirement that they're going to have a lot less income. They don't, because they have a lifetime of building wealth skills. So they're used to like owning assets and real estate and things that appreciate in businesses. It's like, so this whole, we're not going to make much money in retirement. It's like, well, a lot don't, but people that work with advisors generally do, and they have all kinds of income. So does that answer all of the question?
It does. It does. Now there was in the big beautiful bill, allegedly Social Security is going to be non-taxable to a certain group. So that's an interesting aspect going forward too.
Yes, the comment was the OBBBA, the big beautiful bill, did talk about taxability of Social Security being reduced. I would say most people listening to this are not going to be in that dynamic. They should have been listening to stuff like this years back, right? I mean, I don't think it's too snarky. But yeah, that's generally not, nobody in this room is going to get a break under any of those rules.
Right.
So, all right.
Are dividend reinvestments taxable? Like DRIP?
Yeah.
That's not taxable, correct? Or am I wrong there?
So the question is dividend reinvestment taxable? So yes, it is taxable.
Okay.
So think of it in two transactions. So when you get your 1099-B, tax shout out nerds. So you get your 1099-B every year, it's going to list all your interest payments and your dividend payments. You're taxed on that amount, whether you take it to your mailbox and spend it, whether you reinvest it in that stock or whether you reinvest it into another investment. It's all going to be taxable. But those dividends, what's nice is they are taxed at a favorable rate. So below certain income levels, and again, that can catch up to you pretty quick. But if you're making 150K or below, then you're probably getting those dividends tax-free. So maybe in retirement, if somebody's making more than that now, maybe in retirement you're making less than that and getting a break. But they're definitely, they're going to go on there as being taxable. Then we'll see what the percentage is tied to those particular dividends. All right. Any other questions? It looks like she has a question.
No, I don't.
She doesn't have a question. All right, thanks everybody on the live stream for listening in. Send questions in to VIP services ankerstarwealth.com, and we'll get those turned back out to you tomorrow. So thanks for listening. Bye. Loud applause on the live stream. Really loud.